So what is free cash flow, or in other words, free cash flow to the firm? So there are two types of free cash flow. Free cash flow to firm is free cash flow from all investors' point of view. So free cash flow that belongs to both creditors and shareholders, even shareholders of common shares or preferred shares, so all investors. On the other hand, we have another concept called FCFE, which is free cash flow to equity. So if you have studied CFA or studied corporate finance, you probably would have heard it. But that is, different in the sense that it's cash flow that belongs to only the common shareholders. So it's slightly different. But in most, actual practice, or in most, even lectures or other institutions that teach financial modeling, usually we use FCFF, free cash flow to firm, in order to calculate enterprise value. By definition, it's cash flow that belongs to both creditors and shareholders, and it's a cash flow after excluding all necessary cash flow for a company to maintain its business in the long run. So it's excluding necessary cash flow such as CAPEX, capital expenditure, and net working capital. So there are many different types of formulas, and you can start from cash flow from operations, or you can start from net income. But normally we start from EBIT or operating income. So by starting from EBIT, you have already excluded labor costs, marketing expenses, R&D. We've excluded depreciation and so on. So we've excluded all of the operating expenses by starting from EBIT, and then we exclude tax, because tax, the creditors and shareholders, they cannot claim rights for the tax. Tax has to be paid. So the cash flow from cash outflow coming from tax should be subtracted. And then we add depreciation and amortization, because EBIT minus tax, these should have been in accounting terms. So we're changing accounting terms into closer to actual cash flow, and depreciation and amortization is one of the biggest components that have differences between accounting standards and cash standards. So we're adding D&A. Some people also add other non-cash costs. Some people also add non-cash costs such as pensions or impairments and so on. But that really depends on analysts. So this formula can be slightly different from people to people, just as enterprise value was also very different. Depending on the definition was very different depending on each individual analyst. Free cash flow as well. This is the most basic and most popular formula, but some people might have slight differences on the actual formula. But the gist is that it is cash flow that belongs to all investors. So we've converted. So we've subtracted tax, and then we've converted into a cash flow metric. And lastly, we're subtracting capital expenditures and investment in net working capital, simply because these two cash outflows are essential or necessary to maintain its business in the long term. So these two cash outflows, even these investors cannot touch, cannot claim, because once they claim it, the company is going to stop growing or go out of business or something. So the formula looks like this. From EBIT, we subtract tax, we add depreciation and amortization or non-cash costs, and then lastly we subtract capital expenditures and changes in net working capital. Some people prefer to start from cash flow from operations. In that case, the formula would be cash flow from operations minus capital expenditures, which looks much more simple. But for many reasons, we use this formula instead of the formula that starts from cash flow operations.